The difference tax planning can make on your tax bill in this week's fastest 4 minutes in finance. Hello, I'm Scott Inman. The tax deadline is behind us now for 2025. So how did it work out for you? Did you owe money or did you get a refund? If you owed money to the government, it can be a real jolt to your savings. At GenWealth, we're not CPAs and we're not offering tax advice, but we do believe the best way to settle on tax day is to break even. You don't want to have to tap your emergency savings to pay a big tax bill, and getting a large refund may feel good, but you've been loaning it, in essence, to the government all year, and you could have done more with your money for you and your finances if you kept it. So if you got a big refund this year, consider decreasing your paycheck withholdings. But if you owed money, there are some ways to plan ahead and not be scrambling to find a way to pay your taxes next April. First, check your W-4 form that you filled out for your employment. This set up your tax withholdings. Is your filing status correct? Are you claiming the right number of dependents? You can decrease this and it will increase your withholdings. You may also be able to ask your employer to withhold a little extra from every paycheck. The next thing to check is retirement contributions. Are you maxing out your 401k? Oftentimes a worker stops at the match. In other words, if their company offers a 5% match, they contribute 5% of their salary, and they may even think they're maxing out their contributions. Well, don't think of your contributions as a percentage of your income. In 2026, you can contribute up to $24,500 of your income, and if you're 50 or older, you can contribute an extra $7,500 on top of that. There is also a special catch-up if you're aged 60 to 63 that totals $11,250. It's important to note, if you make over $150,000 a year, the catch-up contributions must now be made in Roth dollars. But there could be significant tax savings for a two-income household if the spouses are not currently maxing out their retirement plans. Another place to save is through HSA and FSAs. The health savings account is a triple tax advantaged account. Your contributions are tax deductible in 2026, they grow tax deferred, and withdrawals are tax-free, as long as you use them for qualified medical costs. A flexible spending account is great if you know you will have ongoing medical bills or drug costs. It allows you to make pre-tax contributions during the year to an account you can use for those healthcare costs. And both of these accounts may be offered through your employer, so it's certainly worth checking out. And finally, get serious about tracking your expenses. Things like mortgage interest, property taxes, business mileage, charitable contributions. About 90% of tax filers take the standard deduction, and most don't have enough qualified expenses to itemize. But if you're filing on your own, you may not know if you can. Tracking your expenses can let you know at year's end if there's an opportunity to increase your tax deductions that could lower your bill. Bottom line here, find a financial team, including a financial advisor and a CPA, who can work together to minimize your tax bill and better prepare you for retirement.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.